So as the general valuations of the US market tracking near its all-time highs, plus some of these Hong Kong Chinese tech names that rebounded extremely violently over the last 2 months or so. And I think it's a timely check-in for us to review the stocks in our portfolio and to look at how Mr. Market is according valuations to them and the potential risk reward. So 10 months ago, I actually published a video saying I revalued almost every stock in my portfolio. And this was the screen grab from the previous Excel that I extracted. And on top of that, I've included a column that displays the current prices of all the existing equity. And look at how time flies. So some of these names, specifically the 2 Chinese big tech companies, have grown into my intrinsic value based calculation. On the other hand, some of them, like TSM and Meta, even outgrown my optimistic case for 2024. So I think it's always good to review how the companies have performed over the last 1 year and to update our valuation models. In fact, it seems like a quarterly tradition on Wall Street where analysts will be revising their price target. And given this recent rally of Alibaba, most, if not all of them, have increased their price target. Sometimes I don't know whether the price action of the stock is affecting their targets or the other way around. Just a huge ass disclaimer before we start. Discussions around topics like price targets, financial expectations, numbers, etc. They're basically put out of all of our assets. So don't treat it too seriously and just look at it as some sort of a references, but don't live or die by it. With that aside, I think diving into my portfolio specifically, you can see that I run a pretty concentrated portfolio and there are quote-unquote important positions. And if they're below the 3% benchmark, they're considered a starter position for myself and it's under the KIV list or keep in view. And in fact, if you to exclude the VWRA ETF, I actually have 7 core positions. And specifically for this video, I'll be breaking down the valuations of these 7 specific companies and to give you my base case and optimistic case, if any. In the name of transparency, and also a public service announcement for long-time viewers, I actually sold out roughly 1/3 of my Meta position, but I'll talk more about the valuations in the later part of this video. I basically just did some sort of a mental accounting where I booked the profits to the cost price of my Meta. It's just an easier way for me to keep track in terms of my cost basis. And given the recent price action in the Hong Kong market, I know that some of you are extremely excited to take advantage of this volatility. So I have some exciting good news for Singapore residents. So Longbridge is a new broker in town with a capital market service license and is regulated by the MAS. And they are currently offering lifetime commission-free trading for US and Hong Kong stocks. And in fact, new users to Longbridge can now participate in their welcome rewards campaign. And you just have to deposit a cumulative amount of 2,000 Singapore dollars and maintain it for 30 days and complete 3 buy trades. And you'll get to enjoy 1 Nvidia shares worth roughly 190 Singapore dollars and $50 worth of option cash coupon. And if you have a larger capital base, you can maintain a net deposit of more than 10,000 Singapore dollars for 90 days and complete 5 buy trades. And you get to enjoy 1 Apple share and $50 worth of option cash coupon. Furthermore, you get an additional $18 affiliate exclusive if you use my link below. And in terms of a total rewards package, you're looking at $18 plus $66 worth of options cash coupon and 190 Singapore dollars worth of 1 Nvidia share. And that's $274 on a $2,000 deposit. So that's around 13.7% return in 30 days. And this sign-up event will conclude on the 28th of Feb. And for those of you who have not created an account yet, feel free to use the link in the description below. So with that in mind, let's talk about my target prices. So this is an overview of the 7 core positions. And of course, as the largest position goes, we have to first talk about Alibaba. So traditionally, for some of these much more matured businesses with established market position, and you don't expect a lot of volatility ahead for them, analysts like to use this model called the discounted cash flow model, where you essentially just project out the income or project out the cash flow and discount it back to the present value of the cash flow to get some sort of an estimation. So you can take a look at this simple model for Alibaba back in April of 2024, where I did a simple projection for the next 5 years and I had a target price of around $147 per share. And just keep a small nuance at the back of your mind where Alibaba ends their financial year in March of every year. So this projection, I believe the March 2024 quarterly numbers was not out yet. So it was still considered the earnings estimate. And I basically predicted that in the next 3 or 4 quarters ahead, until March of 2025, we will still experience some sort of a slow down or negative growth in terms of cash from operations, and the capex will grow by 50%. However, as we have known, if you haven't catch my latest video, tech companies being tech companies, even though they are matured businesses, a lot of their capital decisions tend to surprise investors, and it's really a hit or miss. Sometimes companies say that they wish to spend a lot of money, investors don't like it. But in this specific Alibaba case, investors seems to love it. So just putting in the numbers again, the March 2024 figures are already in. So I pushed it to the actual numbers, and out into 2025, we still have one more quarter ahead, confirm the figures here. But I think that we are still looking at some sort of a negative 10% cash flow from operations. I took an in-between figure, and we know that CapEx is also expected to grow exponentially. And right now, based on the current estimation, they already clocked in for the 9 months of 2024, roughly 60 billion RMB. So I'm expecting another 20 billion, so that it basically estimates 80 billion in capex. And in my previous video, I've basically estimated the capex of the next 3 years to be right around 15 to 20 billion US dollars. And if I use 15 billion as the benchmark, that's roughly 108 billion RMB. So I basically just grew from 2026 to 2028. I'm just assuming that they are blowing 100 billion in RMB in terms of capital expenditure. And top line growth rate will kind of grow in line with their top line earnings based on my own expectations of 15 and then slowing it down to 12%. So in 2029 specifically, I did drop down the capex by 30% because I don't expect them to continuously step up the capital expenditure because there should be a harvesting period. And this 3 years is really just based on the guidance of the management team. And just looking at the past, I guess, 7 years of the growth of the company, you can see that capex always also move in cycles. There will be high capex periods, and then they will come back or normalize back down to the maintenance capex, because now the capex number has two elements. One is for growth and one is for maintenance. So I don't believe that the maintenance capex of this business will be hovering at $100 billion for the foreseeable future. So in 2029, I brought it down to kind of estimate the so-called real free cash flow margin, and I took a terminal multiple of 18x, and that's how I got all the cash flow that's going to be generated by the business. So I discounted based on a 10% rate, and I got a target price of roughly $170 per share, and there's still some sort of an 18% upside. But of course, all these are purely speculation and estimation. The only thing that is probably closer to the truth or reality is this 2025 estimate, because there's only one quarter left. So, however, how the cash flow from operations is going to grow into the future, your guess is as good as mine. So how is the capex profile going to look like in the foreseeable future? So is it going to come down? I'm fairly confident that it's coming down, but to what extent, I don't know. And in terms of what kind of premium multiple that the market is willing to pay, really depends on the sentiments of the investors. So I think at 15 to 18x, I think it's still fair for this tech juggernaut. So that's how I basically arrived to around $170 per share. And just looking at their relative historical valuation, using their price to operating cash flow, I don't necessarily look at the price to earnings of Alibaba, because the bottom line earnings of Alibaba tends to fluctuate quite wildly due to the writing up or down of their investment portfolio. So using a price to operating cash flow kind of multiple at around 15x today, I think they're still kind of a far cry from their median multiple of the last 10 years. However, it's definitely on the higher end if you just compare in terms of their depressive state in the last 4 years during the Chinese tech bear market. So I think it's really up to you to decide. But in my own humble opinion, I think reverting back to an 18x multiple, I think it's still fair, and to me, that's how I basically estimate around 170 to 180 to be Alibaba's current fair value. Now, moving over to the second largest position, which is Tencent. So I've just realized that there is a typo, but this should be 2025. But my base case intrinsic value estimate is roughly $614 per share. And at a current price, there's roughly a 19% upside. So looking at Tencent, this is my most updated valuation model. They haven't closed out their financial year for 2024. We're still waiting for the last quarter. But I think a reasonable estimation in terms of their cash flow from operation is that for the first 3 quarters of the year, they have grew roughly in line between 25 to even 30+%. So I think 25% is on the more conservative end. And in terms of their capex, I think like Alibaba, many of these Chinese tech companies, they're in their high capex spending era. And similarly, for the first 9 months, they have already grown their capex number by 100, 200%. So I think at 120%, I think it's a rough estimate. So I then project out the next 4 years, their cash flow from operations, and this is roughly in line of their revenue figure. And since just in the name of conservatism, I do feel that they're just going to continuously jack up their capex expenditure. So I just flatline it at 20%. And calculating Tencent at an 18x free cash flow multiple, discounting at 10%, I have a price target of around $614 per share. But looking at a more optimistic projection at 725, I do think that Tencent will probably command a much higher free cash flow multiple than Baba. So I put a 22 times, that's how I got $725 per share. Secondly, I think looking at the price to operating cash flow multiple of Tencent, Similar to Baba, in the last 4 to 5 years, they have been beaten down at depressed valuation, currently trading at 17 times price to operating cash flow. I think going back to 20 or 21 times should be fine. That's why there is still at least a 20-30% some sort of valuation expansion to go back to fair value. So that's on Tencent. So the third company in my portfolio is Moutai. So specific to Moutai, I do think that they are probably roughly in line of their fair value territory. I think Moutai right now is in a special scenario where they are currently experiencing some sort of an identity crisis. And if you take a look at the past 10 years of how they've basically traded, and just to look at the first chart, this is basically their price to free cash flow and their price to operating cash flow. And they are very nice in line, trading currently about 30 to 32 times. And this is probably the median multiple if you look at the past 10 years of their history. So trading at 30 times definitely don't look cheap, but you have to come from the perspective that Moutai has been traded as a luxury company for quite some time. And investors are basically casting aspersions in terms of their growth rate and margin moving forward from here. And similarly, you can look at their EV/EBITDA. They're currently trading at 14 times and it's definitely on the lower side. So how do you look at Moutai's valuations today? I think at 30 times, they are probably trading at near fair value. I think on a more optimistic case, if they're able to be re-rated as a luxury company again, then yeah, I do believe that going back to the 2000 range would probably be fine. But I've included Moutai in the portfolio, not because I'm begging on the market, I'm trying to re-rate their multiple back as a high quality luxury company, but more so I'm just buying into fear and how investors are skeptical of their growth and margins. But I do think that this is a high quality company that is deserving of a hold for the extremely long term. Now moving on to Amazon, I think specific to Amazon, I'm just using purely a price to operating cash flow perspective. But just to give you a flavor in terms of how I did the DCF previously. So in 2024, this was my previous estimate where I expected them to deliver a cash flow from operations of around 100 billion and their capex to also go down to around 40 billion because they were coming out of their high capex era. But like I said, for many of these tech companies, they basically reinvest whenever they see opportunity. So in their most recent 2024 financial year ending, so cash flow from operation actually beat my own estimate, coming at around 115 billion, but capex also ballooned significantly to roughly 82 billion. So my projection out for the next 4 years, I think it's roughly in line with their revenue estimates, but I did put a little bit more premium in terms of the recovery of their margins. I'm looking at their ads and also their main commerce business. We are looking at margins slowly coming back. So that's why I do expect cash flow from operations to also grow at a more significant rate. But yet at the same time, I think for their capital expenditure, Amazon has not spent that much money in their entire history, and I'm still expecting them to grow it 10% out into perpetuity. And the free cash flow multiple that I did tag on the business is roughly around 25 times. Discounting it at 10%, I do get a price target of roughly $200. And this is lower than my base case of roughly $235 per share, because for the 235 kind of base case scenario, I'm just looking at the price to operating cash flow of roughly 22x, which is more in line of the median multiple. So they're currently trading at roughly 20 times. I do think that there's still some room for improvement. But I think in terms of this discounted cash flow, like I said, a lot of these numbers are just estimates and we are probably going to be wrong. So I just need to directionally be correct. And if Amazon is able to continuously swell their margins again and capital expenditure don't grow like 30, 40, 50% year on year consistently for the next 4 years, I think these numbers are still considered fair for Amazon's behemoth of a business. Now, moving on to the next company, which is Alphabet. Specifically for Alphabet, I have a base case of around $180 per share. But really just looking at their current relative historical comparison, price to free cash flow of 30 times, price to operating cash flow of 17.6 times. Google is also experiencing some sort of an identity crisis where investors are casting aspersion on the search business. And you can also see that there really isn't a very sexy story to sell for Google. That's why their valuation always tend to be on a more conservative and not so crazy side. They don't go to 40, 50 or 100 times price to free cash flow or operating cash flow. And they have been a relatively disciplined business. So looking at the current benchmark and how they've been performing, I think they're probably right around fair value as well. Will I be adding at today's prices? Probably not. So moving on to Taiwan Semiconductor, I also have a price target of roughly $180 per share. I think it's right around fair value. I'm not very interested or eager to take profits now, but I think there's a going concern around most semicon related companies is that we do know for the 2025 output, specifically for Nvidia and some of these hyperscalers, the orders are already booked. But as we know, semiconductor tends to be quite cyclical, and the worry is whether TSM has already entered into part of the peak cycle. So just looking at some of their numbers, price to operating cash flow 15x. So they're not demanding per se. So I don't think TSMC is extremely overvalued. But the worry, like I said, is that if they are really in peak valuations today, so margins are probably near the all-time high, and the free cash flow today might not be sustainable. And that's mainly the problem when investing with companies in this sort of cyclical industry. But for now, I think I just adopt a wait and see approach. Still looking at TSM, not urgently trying to sell them. Don't think they're very overvalued, but I think ceteris paribus, if nothing major happens, they're probably fair value. Now, lastly, I think looking into Meta platforms. So as mentioned in the earlier part of the video, I've decided to take some profits off the table. So this is my most updated model for Meta, and just comparing my own expectation for Meta in 2024 versus what they've produced, they've definitely blown my expectations off the water. Cash flow from operations grew at 28%. I only estimated 18. For CapEx, they actually grew lesser than I estimated. I expected 39 billion, but they came in at only 37. So it's really a twin engine where they improved their margins, delivered more cash flow from operations, yet at the same time reduce their capital expenditure. Simple projection for the next 4 years, these are roughly in line for their revenue growth estimates, and I do expect them to continue putting more money to capital expenditure at 20 to 15% and tagging a free cash flow multiple of 30 times. 30 times, by the way, which I don't think is normal for Meta because they are so-called, again, similarly, maybe near their peak cycle. Discounting it at 10%, that's where you get a price target of 680 per share. And if you observe my own target price overview, 680 to me is really on the optimistic end. And if I were to be much more conservative in terms of my multiple and the growth rate ahead, that's how I only got $580 for my base case. And in fact, I think 580 might even be slightly aggressive. Looking at their current multiple for both price to free cash flow and price to operating cash flow, they don't necessarily look extremely expensive. Just take a look. If you do a median average calculation, they are roughly in line, like price to free cash flow 30 plus times in line of median. But that's it. I think just looking at their most recent earnings and how the company has developed over the years, they really do feel to me like they are currently at peak operating margins. And yes, I do understand Meta is a pure play advertising company. That's why they have such a high margin. But also don't forget of the expectations that's being baked in, because implicitly at $680 per share, the market is expecting this sort of margin to be sustainable, that is able to grow out into perpetuity. And of course, with this high multiple that they're tagging to the business, which in this case, I think if the margins start to come down or if CapEx start to jack up again, multiples can very easily re-rate back downwards. And that's why I kind of decided to take a little bit of profits off Meta platforms. And of course, I'm ready to build back up my position again in Meta if Mr. Market decides to throw a tantrum. So I think just to end off, my concluding slide is that I was culling through some of my Excel records and just looking at some of my portfolio updates. And I just wanted to share that in Q3 of 2022, that was the inflation bear market. You can see that I was basically across the board. Every single position was down. And back then, the good old days, Baba was trading at $81, Meta was at $133, TSM was at $69, Amazon was at $114, Google was at $99. So here's always the conundrum. When there's a bear market, when every position is red, do you still have the courage to pull the trigger and to add to your position? Well, on the flip side, I think everyone is feeling excited now. Investors are very happy at their all-time high portfolios. Businesses are probably trading at premium multiples compared to their historical averages. And you might potentially fall into the trap thinking that you are very good at investing. And personally for myself, I do find it slightly harder to hunt for opportunities to add to some of these positions. But with that said, I think feel free to leave in the comments below on what are your price targets for some of these names. And with that in mind, I'll see you guys in the next video. But more importantly, and hopefully, I'll see you guys on the moon. Goodbye.